Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome into the Chit Chat Stocks podcast, a podcast to help you find your next great investment. My name is Brett Schaefer, and I am joined today by my co-host, Ryan Henderson. We have an episode that I think will hope spice things up for the audience. It is a new type of episode that we're going to be doing in 2026. We are exploring our first thematic sector, secular trade, however you want to call it, thematic investing. We're going to look at a specific sector to potentially invest in for 2026 and the long term. After listening to this episode, we hope you better understand the industry or sector at large, and maybe a few stocks to your arsenal, watch list, what have you, learn about a couple new companies. These episodes are taking a look at a secular theme. We're not trying to find, we are trying to find some potentially interesting companies. But the stocks that we talk about today are not going to be direct recommendations. They are simply some ways to illustrate said theme. You might find some of them buyable, watch list material, maybe even potential shorts, but we're going to look at the sector and try to answer after, all right, are we more interested in studying these businesses further, doing some deeper research outside of a cursory dive? Let's see, as always, some housekeeping items. Any listener, please give us a review on Spotify or Apple Podcasts. Think of it as the best way to give thanks back to us. It is completely free. If you have somebody you think would enjoy this episode, don't hesitate on sending them a link as well. So, without further ado, today we are just studying the defense sector. We're calling this maybe ranking top stocks to buy for a defense spending boom. We're calling it the defense spending supercycle. We haven't decided the title yet. Maybe Ryan can throw out some ideas as well. We'll decide that after the episode for the final title. But why are we doing this? Because, well, the defense budget in the U.S., as well as Europe, East Asia, other U.S. allies, is really starting to rise again. Quote, U.S. defense companies rallied after President Trump called for a $1.5 trillion defense budget, more than $500 billion more than the Pentagon is expected to receive this fiscal year. Trump said the increased budget was necessary, quote, especially in these very troubled and dangerous times. We'll take that last part. You could have those conversations. I guess not on this podcast about the political news, geopolitical stuff, war stuff, what have you. We're going to be talking investing themes on this episode. But Ryan, before I kind of give an introduction to the sector, what do you know about defense stocks? Do you own any defense stocks? What are your thoughts on the sector before we go through this episode?
I don't think I own any at the moment. Maybe some that are like ancillary to it. But no, I don't have a ton of experience investing in the industry, but I really like the secular trade here. It seems to me like, the sector trade, where you don't necessarily have to be a specialist to make money in this case. Like a $500 billion budget increase is a tide that lifts all boats, I imagine, for most of the prime contractors and a lot of defense contractors in the U.S. So we'll get into it, and I think you've got some more data around just how much spend is going on globally for some of these contractors. But I think there are some interesting companies to look at. I've got 3 today that I found pretty intriguing that could be big 2026 winners.
Yeah, but we're not just looking for anyone that just thinks, oh, they're going to look at Lockheed Martin, General Dynamics, whatever. We're not just looking at the big 5 primes. We're looking at some smaller companies as well. But yes, for some context on the sector as a whole, a $500 billion increase would be massive if you combine this with the $600 billion roughly in defense spending from U.S. allies, which would include Europe, Australia, East Asia, and Israel. You have $2 trillion in global defense spending in 2027 and beyond. But I should note that 75% of that will still be driven by the United States. When I think about this in context with, you have things such as the recent Venezuelan operation, the Iranian threat and uprising, the Russian war in Ukraine, and China, honestly, maybe this is my patriotism speaking, but I would be worried about defense spending without China in the mix, because if you look at the Venezuelan operation, there was just no stopping that at all. The Iranian stuff seem like a very weak country. Russia is in a longer war with Ukraine, a tiny country, than it was with Nazi Germany. And then the Iranian government, maybe after we publish this, will have fallen. Cuba's also toast. There's a lot of other stuff we go on there where China seems like the one threat that the U.S. is really investing towards not, or I guess matching and making sure they're on par with them. And China's spending around $500 billion a year on defense when adjusted for purchasing power parity. It's not nearly as much as the $2 trillion from the U.S. and its allies, but it's sizable. And of course, it keeps talking about openly about quote unquote retaking Taiwan, which is a very complicated story. I would say it's never actually was under the Chinese rule. Sorry to any Chinese listeners. The Dutch and the Spanish, I guess, have much of a claim to it as that, or the Japanese or the Koreans. But it is leading to increased investments from the United States if that threat, grows and grows and grows.
Again, the list of geopolitical concerns could go on and on. Like there seems like a million reasons right now that citizens all over the world should be cautious, and I think that's reflected a lot in the news, maybe amplified more than it should be in the news. But I saw a viral post on Twitter, and
hopefully this is true.
I hate to share some of these things because I want to make sure they are true. I'm not totally sure, just to be clear. So this, maybe anyone that's listening, fact check me, but it was someone from the Venezuelan security team, I guess, and it was like an interview with him around basically what happened, like what did they experience when last week. And if you read through it, it basically sounds like a pitch for U.S. defense contractors, because it sounded like a very technologically advanced operation where it wasn't, there weren't a lot of casualties in the process, which you can't really think of a better, I guess, process.
0 casualties on the U.S. side, yeah.
So anyway, I recommend people reading it. And that was kind of, I think, part of what inspired me to want to look into this sector a little more. That plus the absolutely massive, I think, 50% budget increase proposed by the president. So I'll let you keep going here, but I'm excited to get into a few of these companies.
Yeah, and on top of this, we also have the new space race unfolding. We have the commercial competitors of Rocket Lab. SpaceX is readying an IPO at a potentially blockbuster $1.5 trillion price. You have missions from the United States to go to the moon and Mars. I think China is also competing with that as well, although I'm not an expert in all that stuff. There's opportunities out there for satellite players, technology for the so-called Golden Dome. There's immigration stuff, drug smuggling, terrorism focused missions. It goes on and on and on. And when I was thinking about how does one invest in this theme, again, you can look at the general contractors, or I wouldn't even call them the general contractors, the prime contractors, the giant ones. Those seem a little bit stodgy, a little bit boring. We want to spice things up for this episode. And honestly, it comes back to the comments made by the president about the quote, certain capabilities they have, or we have, in regards to the Venezuelan operation. And from what we're aware of as the public, the U.S. military was able to use some sort of technology to, quote, shut off the electricity in Venezuela, freeze all their anti-aircraft equipment, and basically blind their entire security apparatus. So when I'm thinking about investment themes for this, it's really that technological advantage, cyber tech, surveillance, jamming, software systems, AI, satellites, and stuff in that nature. So with that in mind, Ryan and I, we went about a different way. I utilized both Fiscal AI, our sponsor with screeners, and Google Gemini to look at different defense tech companies that may be benefiting from this increased digital spending. Of course, again, like I mentioned, the prime contractors will benefit, but everyone knows about those. I want to look at some other ones as well. There are also stocks that we have touched on before, such as Kraken Robotics and Rocket Lab, which we are going to let stand as their own episodes. Those are definitely related to the defense space, but we're not going to be talking about them today. Below, I have 4 stocks, Ryan has 3. We're going to kind of go through maybe 5 to 7 minutes each, discuss them, but I think maybe after the episode, we can rank the companies. We can talk about ones we like, don't like, and we can kind of conclude with, are we more interested? What's the conclusion question I have for us? Are you more or less interested in defense stocks? So I have my first one loaded up, Ryan, but anything else generally before we get started here?
No, I'll just say these are intended to be mostly quick hitters, brief synopsis of the business, what they do, why would they benefit, maybe some financial stats, but not necessarily big episode, like full episode deep dives by any means. But I'll let you go first. You have some more, I guess,
A little more cyber
less obvious
software. Yeah.
I would say less obvious beneficiaries here than my list. So why don't you kick things off?
Okay, the first one, and I hope I'm pronouncing them right. It's Leidos or Leidos, Leidos. Ticker is LDOS. Market cap's $25 billion. This is the largest company I looked at here. It's a hybrid defense and civilian government contractor. They're focused on digital infrastructure, IT backbones, all of that type of stuff. 87% of the revenue comes from the U.S. government. From their annual report, quote, our mission software aims to provide the decision advantage for protecting the homeland, securing critical infrastructure, enabling logistics, and conducting multi-domain operations. Long story short, they run IT and software that connects all parts of the U.S. military together. For example, we're going to use the Venezuelan operation because that's so recent in mind. But in the Venezuelan operation, many branches of the military had to work together, likely using Leidos software. I believe these are recurring contracts with extremely high switching costs, giving them a nice steady runway to grow and probably some pricing power when contracts come up. They also run air traffic control in the United States, as well as the healthcare systems for, I believe, not the government, but specifically military stuff. And that's actually their highest margin business, which gives them some diversification, maybe some steadier stuff away from any defense down cycle. On top of this, they run intelligence software for the NSA and CIA to track the movements of targets, I guess, all for your safety. Everyone, don't worry about those privacy concerns. For example, it has been reported that the CIA had Maduro's movements down to a T. Mossad has also been doing this in Iran for a very long time. I think they're probably using, look, we're just speculating, but if you look at the annual report and you look at what these militaries are doing, they're probably using Leidos software. And lastly, the company is working in hypersonics and autonomous ships called Sea Hunter that tracks submarines, and autonomous ship called Sea Hunter that tracks submarines. For that one, I kind of think, well, hey, maybe another beneficiary for Kraken Robotics. If we look at their latest quarter, I mean, it just seems like they have a ton of tailwinds at their back. Backlog was $43 billion, 1.3 times book to bill ratio, which is not bad. For anyone that doesn't know, book to bill ratio is essentially, the definition is in the title. It's how much bookings you're getting versus how much you're billing. So if you're getting a higher than 1 times book to bill ratio, it means you're getting more orders than you're able to fulfill, and your backlog is growing, and it means that your overall business is growing. So if it's above 1, that's a good sign. Since 2016, I know I'm giving a lot of stats out here, and we have a nice chart from our friends at Fiscal AI. Their operating income growth since 2016 is 20%. I would like to look at the past few years because if you look at the chart, for any of the listeners, you can pull that up on Fiscal AI. It's jumped significantly in the last 2 years. I would like to look at what happened to have this nice jump in earnings because maybe there's some normalization that's going to happen in 2026 for the next few years. That's going to play a role in the valuation. But I mean, beside that, that is solid performance. If you look at the EV to EBIT, our preferred earnings ratio for quick hitters, it's under 15. So I think quite interesting.
Yeah, based on headline numbers, this is probably the most interesting one I've seen on the list. I did not realize it had an EBIT multiple below 15. I would like
Yeah.
to dig in and kind of get a sense of, is there some normalization that is going to happen over the next few years? What do we
Right.
analysts
Is
expect?
Palantir taking a lot of their contracts or something like that? Right. Yeah.
But yeah, I mean, just looking at trailing financials, that looks pretty impressive. And I imagine these are very, very sticky deals. Is there any portion of their business that's commercial, or is it all pretty much government?
87% of its revenue comes from the U.S. government. I believe the rest is from allies. So No,
Wow. All right. I'm going to get to my first stock here, unless you've got any other comments on Leidos.
I don't. And if we're mispronouncing that, any Leidos experts, apologies.
Just before I get to the first stock, I want to add a little more color on Brett's comments that he had at the top of the show. So first off, the Trump or the budget proposal. This was an informal proposal for a budget increase. As far as I can tell, it was just a Trump tweet / Truth Social post. However, people are expecting that the White House will actually follow up and release an official budget proposal in March. So right now it is uncertain. Well, it's uncertain whether or not the proposal actually passes. But since it was an informal proposal, we don't actually know what specific sectors would see the biggest budget increases. So we don't have a sense of like $20 billion extra is going to the Golden Dome versus like submarine development, that kind of thing. So you kind of have to, I guess, probably assume that it's widespread and going to all sectors of the defense industry.
I think it's likely. Well, there's some stuff that's going to be given it has to have a budget. Things like the F-35 and the Virginia class submarines, which are just they're going to get their money no matter what. But if you look at the cutting edge stuff that we talked about in the opening, drones, underwater drones, satellites, the Golden Dome stuff, missiles, sensors, software, AI, it feels like that is going to. I would bet that it's going to get an increase in spending proposals.
If you're a regular listener to Chit Chat Stocks, then you know that we love investing in international stocks, and no brokerage compares to Interactive Brokers, otherwise known as IBKR, when it comes to international trading. You can easily trade assets worldwide using a multi-currency IBKR account in 160 markets, 36 countries, and 28 currencies with low fees. Compare that to your existing brokerage and its limited trading ability and high fees on foreign exchange. There truly is no comparison. Trade stocks, options, futures, currencies, and bonds globally with IBKR's unified brokerage platform. I wouldn't use any other brokerage for my investing needs. Switch to IBKR and level up your international trading game today. If you're interested in checking them out for yourself, head on over to ibkr.com. Interactive Brokers is a member of SIPC.
Yeah, I said here, just given the tone and a lot of the commentary, I guess probably over the last year and some of the operations that we've seen, my assumption here is that a lot of the budget increases will be focused on advanced weaponry, AI and software, as well as probably a lot of space tech as well. There's been a lot of talk about satellite surveillance, and obviously we've seen a lot of capital pour into the space economy over the last year or so. But since we don't have any specifics, I ran a broad screener for U.S. defense and aerospace stocks on Fiscal AI. Pretty simple. And by the way, this screener is totally free. So if you're interested, I think this is a great way to find a list to rip through. If you're interested in the sector, just go to the screener. In the industry tab, look for defense and aerospace, filter whatever countries you prefer. In this case, I was focusing specifically on the US, and I wasn't really necessarily just looking for the cheapest stocks or the highest dividend yield or anything like that, because I think it's maybe a misleading way to find companies here. But I basically kept it open-ended. I wanted to see what were the fastest growers, what were the EV to EBIT multiples of all these, and maybe the highest dividend yields. There aren't, aside from TransDigm, which I don't actually believe has a very large government business, it's primarily commercial. There weren't any big contractors that had sizable dividend yields. So, unfortunately, wasn't able to find any of those. But I just kind of ripped through this list, clicked on each one, used some Gemini help as well, and I found a few that I think are interesting. I'm not going to go through the whole list over audio, but if you're interested in pouring through companies, I recommend going with that approach. The first company I'm looking at today is sort of a safe play. It is the second largest defense contractor by market cap and the largest by revenue. It is RTX Corp, formerly known as Raytheon.
Did you know they specifically got called out by the president in an extra tweet / truth I don't know exactly what they did, but apparently he's not happy with them. So they get extra scrutiny for the buybacks and dividends. But either way, I mean, you're about to go through it. They just have rock solid contracts that aren't going away.
Yeah, and I think all of the sizable companies have been. They look like the easiest to critique because nominally they spend the largest amount on buybacks and dividends and capital returns. So it's easy to say they spent $10 billion on buybacks or whatever instead of investing. But like Boeing would have done that too if they didn't have all the screw ups. Like it's I think part of that's just the nature of being as large of a company as they are. But yeah, my general belief here is that a $500 billion budget increase is going to benefit a lot of companies. Some are higher risk, some might have higher upside, some might be like less obvious that might get huge bumps in project and bids. But for sure, it would benefit RTX. I mean, they already have the clearance. They've got a lot of the barriers to entry for being a defense contractor they already have. So they're probably one of the most natural companies to work with for certain projects. And obviously they already have large contracts, but RTX operates 3 different segments that are all actually very similar in size by revenue. So Pratt & Whitney is 36% of revenue. This is one of 3 major players in the aircraft engine oligopoly, which I've seen a lot of commentary about the aircraft engine space lately. It seems like there's like this renewed investor focus on the industry since GE spun off their other businesses and they realized
the stock's done quite well. Yeah.
Yeah, and now everyone seems to think it's the widest moat industry, and they do seem to have really wide moats, and there haven't been I don't think any new entrants for like 50 years into the industry, but this Pratt & Whitney gets most of their revenue from commercial customers, so it's not really a focus for this one. And then Collins Aerospace is the second largest business for them. This is 35% of revenue. All 3 of these, Pratt & Whitney, Collins, and Raytheon, are basically all a third of revenue almost. In Collins Aerospace, you can think about it as Pratt & Whitney provides the engines and Collins Aerospace provides everything else. So things like avionics, flight controls, cabin interiors, landing gears, literally just like every system or widget you could think of in an airplane, there's Collins might touch it. The third one here is Raytheon. This segment is focused exclusively on high-end defense technology like missile systems, radars, torpedoes, and electronic warfare systems. The reason I specifically chose RTX is mostly the missile exposure. Trump has been pretty vocal about wanting to build out the, quote, Golden Dome, which would be his basically national missile defense system. Raytheon is the leader here. They generate $28 billion a year in revenue just from Raytheon specifically. Like they generate $89 billion in revenue across the whole RTX business. 28 billion of that is from Raytheon. So they are the largest player, not only in the defense industry generally, but specifically in the missile segment. I want to reiterate that at this moment, we don't know where the extra spending, the budget increases are going. Or we have an idea, but it hasn't been specifically laid out. But I think it's pretty much a guarantee that RTX would capture some of it, which is why it should at least be on people's radars for 2026. They've got a trailing EV to EBIT of 33 times, which doesn't scream cheap, but a lot of that inflated multiple is from the Pratt & Whitney struggles recently, and the expectation is that profit margins should begin to climb again. So forward EV to EBIT looks like much cheaper than trailing. I think it's 24 times on a forward basis as opposed to 33 on a trailing. If I were betting on one single stock from this list today, this wouldn't be it, but it's hard to imagine a massive 50% budget increase for the defense sector not helping this RTX stock.
Yeah, and I wish they almost would just split up the 2 businesses because I don't like that Raytheon. If you're going for, okay, hey, there's a budget increase. We're going to see more spending on Raytheon in general. I don't want the aerospace exposure if I don't like that, but hey, I don't know. All right, let's go through.
They could pull a GE here.
Yeah,
Unlock a lot of value.
The lawyers and bankers are going to do quite well with this one. Bring it together, then split it up, then bring it together, then split it up. We'll see. All right, let's speed through here to my second stock. It's a company I've never heard of at all. The name, I think, is just CACI. I think it had something to do with California, but the ticker is also CACI. They are named, they're called CICI International. And they, quote, provide information solution services for the intelligence of the U.S. government. Market cap's $12 billion. Compared to Leidos and its IT infrastructure, CACI is more focused on cyber tech and electronic warfare. I'd say this feels like a tailor-made business to benefit from the increase in defense spending, especially when the future is cyber tech, drone jamming, all the good stuff. It looks really kind of like the dirty stuff that people don't want to talk about: drone jamming, dark web searches for governments, laser communications in space, and the digital architecture for something like the Golden Dome. When I look at the business, I see steady 10% revenue growth and only a 9% operating margin, which has slowly increased as they've gained scale. Of course, the downside of the defense sector is the lack of margin expansion potential because of those contracts that have regulated margins, cost plus stuff. Although when you look at some of these annual reports, usually it's about 50-50 cost plus versus other type of contracts, which with the cost plus is like, all right, we tell you how much it costs for us to build this, and then you give us a little juice on top for what our margin is going to be. Some of the other ones are kind of fixed fee or more flexible. There's different types, but in general, you're not going to see a software provider have 30-40% operating margins, like even if they would in the commercial environment. But starting at a 9% margin, I feel like they still have a little bit of room to grow here, and it's a good base. You have the steady revenue growth. I mean, look, am I an expert on this business? No, I think they've had a couple of acquisitions too that if you're going to do deep research on the company, you'd want to look into. But it's 10% revenue growth over the last, I believe, 10 years. It might have been 5, but don't quote me on that. The trailing EV to EBIT is 20. There's margin expansion, and it feels like a massive tailwind for these type of services. For example, one thing they mention is that they have technology to allow agencies or parts of the military to use dark web searches to see any sort of potential terrorist activity or threats that you can't find on like the open web, which I would think is going to be, I don't know if it's going to be increasingly valuable, but it's going to be very, very valuable in the future. And I would assume that those contracts are quite lucrative for CICI. It's a very, you could see the intelligence agencies or the government not, like they would need this software to operate in the modern world.
How did you find this one?
I believe I just did a screener, and I don't know, it just popped up. I also tossed in various prompts on Gemini. Build me some defense players that'll benefit from increased spending on various things that we've talked about, and CACI popped up. It's a company. Have you heard of this company before? I've never heard a single person talk about it.
No. $12 billion market cap. I have never heard of that.
It's not tiny. Yeah.
No, that would be, is that large cap? I think that's considered large cap.
I think we need to adjust those filters. I would, if we're doing my own determination, I think it's still mid cap. Large cap to me maybe is 25 billion and above, as we sit here in 2026. Maybe that's the bubble talking to me, but yeah, mega cap 500 billion. I don't know.
All right, let's get to my second stock here. L3 Harris. Bad name. I'll say that. It's a bad name.
Is
L3
this
Harris.
the spin from Lockheed Martin? Or are you about to get into that? Or am I thinking of a different company?
This was a merger of equals in 2019. So there was L3 Technologies and Harris Corp, and they combined in an all-stock deal that immediately basically created made them the 6th largest defense contractor by revenue, and what investors are now calling the 6th prime contractor. Some investors are calling them that. So, like RTX, L3 Harris is now, there's been so many mergers in this industry. This is sort of an amalgamation of a bunch of different segments and subsidiaries. Quick side tangent here. I've said this before, but I'm not a specialist in analyzing defense contractors. In fact, I have very little experience investing in companies like this at all. And keep in mind, this is a very different industry than most. Brett just mentioned this, but margins can sort of be capped if you generate a lot of revenue on a cost plus model. So analyzing it does sometimes, if you're looking at individual companies, you may want some experience, or at least take your time diving into the defense sector for a while. However, I am intrigued because of everything we discussed earlier. And as a generalist venturing into the sector, I'm not trying to find necessarily the biggest home run. I just want to generate above average returns by being in the right spot in the right year. I think that's part of the reason we're doing this episode is we think defense spending is going to be an interesting theme / sector for 2026 specifically and 2027, given some of the budget increases. And for me, that means sticking to the obvious beneficiaries, which in this case, L3 Harris, RTX are both kind of obvious ones. You could even take an ETF approach, but pretty much throughout most of my time as an investor, I've always been a deep dive individual company, know it extraordinarily well, don't trade in and out of it, own it for a long time style investor. However, I've been inspired by some other newsletter writers that I follow where they aren't afraid to get to know a company really quickly if they think the industry is going to do well or if they think there's a specific catalyst or an overall tailwind behind the industry. And they've done well doing that, where it's like, am I the best defense contractor investor out there? No, not by a mile. But if you owned it over the last year, like an ETF, even if you just own the iShares Defense ETF, you got 60% annual returns over the last year versus 20% in the S&P 500. So you can do well betting on specific themes. Anyway, let's get back to L3 Harris. This is more of a conglomerate. I guess any comments there, Brett? I know that was kind of a tangent.
I think it makes sense. The looking at a specific theme can be helpful, and it comes back to, at least for the listeners, not being afraid to invest and then research, where if you look at a company, at least don't do this right before they're about to report earnings, but you can look at a company and say, oh, this looks interesting. I like this theme. I want to invest in it. You could always sell a few weeks later or a month later if you research the business and find that you don't like what you see. But at least for a starter position or your first kind of buy, don't be afraid to kind of jump in right away if you feel that the sector is going to have any beneficiaries. Don't be afraid to just sit there sucking your thumb.
Yeah, agreed. All right, L3 Harris. Let's go through the different segments here. They've got space and mission systems. This used to be two separate segments, but I think they're now reporting them as one moving forward. And the segment is very, very broad. So I'm going to let Gemini give a synopsis here. It says, Space and Mission Systems develops space payloads, sensors for missile defense, satellite navigation, and electric warfare countermeasures. It also handles intelligence, surveillance, and reconnaissance. I might be pronouncing that wrong.
Reconnaissance, recon missions.
And maritime electrical systems. So it's very broad. This segment generates, I believe, around $12 billion in revenue. A little more, almost $14 billion. So a lot kind of under the hood there. And then the second one is communication systems. So this is equipment for troops literally on the battlefield. So think stuff like tactical radios, night vision equipment, secure broadband communications, because you need that when you're on the battlefield. And then the last one here is Aerojet Rocketdyne. So they acquired this business in 2023, and they primarily manufacture rocket motors and propulsion systems for missiles. So if you're looking at the financials on Fiscal AI, you might be thinking, Ryan, what is attractive about this? Growth has been meager at best. They've grown revenue by 3.8% annually since the merger in 2019, and much of that is inorganic. So why own this? My primary thinking here, or I guess why I would be attracted to it, is 75% of the revenue comes from government customers. So, and maybe, I think that was just US government, so maybe even more from international and allied governments. When you get a $500 billion budget increase, you get a lot of new projects, a lot of new development, a lot of new tasks from the government.
Or fund more units for existing systems. Right?
Yeah. So my thinking here is that the next few years could look very different than the last few years, and it's very much if geopolitical tensions get even worse. I mean, I just described the businesses here. You could see those definitely needing to be used. So I think once again, this is one of those beneficiaries where it's a rising tide lifts all boats. They would be someone who's going to hopefully be a landing place for a lot of that budget increase. All right, folks, before we move on, we need to tell you where we get our data. Fiscal.ai. Fiscal.ai is the complete stock research platform for fundamental investors. I use the platform pretty much every single day. You'll see the charts in our podcast. You'll see it in our newsletter. This is our one-stop shop for stock research. They've got up to 20 years of financial data on all companies globally, including the largest company-specific segment and KPI data set on the internet. That includes metrics like Duolingo's daily active users, Oracle's backlog, Rocket Lab's revenue per launch, and literally millions more data points. They've also got earnings call transcripts, ownership data, equity research reports, and much, much more. If you want complete financial data at your fingertips, you need to check out Fiscal AI. And if you use our link, fiscal.ai/chitchat, you will automatically get 2 weeks of Fiscal Pro for free, no card required. If you want to upgrade, our link will also get you 15% off. Again, that's fiscal.ai/chitchat. The link will be in our show notes.
If you regularly listen to Chit Chat Stocks, then we know you love analyzing individual companies. We do too. That is why I, Brett Schaefer, co-host of the show, decided to start writing the Emerging Moats stock research service. Emerging Moats produces regular stock research reports on companies with emerging competitive advantages, regular updates on stocks I own and on my watch list, and has full transparency to my portfolio transactions and returns. I cover under-the-radar emerging moat companies with prior research reports on Oscar Health, Kraken Robotics, The Real Brokerage, and much more. Emails will be sent out on a weekly basis. Explore the service today and find your next great stock by going to emergingmoats.com. The link will be in the show notes. All right, let's go into my third stock, BWXT Technologies. Market cap is actually bigger than the one before, $17.6 billion, but the revenue is not that high. This one is one I've known before. It's an error of omission on my part. I saw they were a monopoly, but the valuation was kind of meh. Their growth wasn't that great. Now it's up 3x from here. I guess the rule of thumb is you should always invest in the stocks that I like but don't love because they seem to go up at an insane rate. Rocket Lab, Hims and Hers, BWXT Technologies, what I'm probably missing a few there. New Holdings, I guess, is on its way to that as well. So here's the monopoly. They are the only company authorized to build nuclear reactors, nuclear fuel, and equipment for the U.S. Navy. I think this is quite an enviable position that will print money for years. I mean, the U.S. Navy has had, I think from the 1950s, a nuclear program, at least in some capacity, for reactors for ships and submarines. And it's going to be around for a long, long time. You have the Virginia class that's going to be, I think, manufactured for the next few decades. They're going to be operational for decades beyond that, at least hopefully. And on top of this, they are researching the ability, BWXT Technologies is the ability to build micro reactors for the Army, as well as deploying reactors into space, working with Lockheed Martin and DARPA, which is the advanced, I forget what it is. It's the Government Advanced Research Projects, something like that. It's where the internet was, I think, made, honestly. Either that or GPS was made from there. Lots of things was made from DARPA. And as a side note, Waymo was started, I think, at least self-driving cars were started from a DARPA project. Either way, that's a tangent. We can go down another day. Commercial use cases are growing for this, for their, the space technology, and they're also looking at potential use cases in the medical field. I will say I have no idea what nuclear and medical stuff combines into. That's something to research further. But this is a company that seems to have a really strong track record of innovation, cutting edge, actually getting research projects out there. Because if you look at some of the other companies in the nuclear space, these quote unquote small modular reactor companies, the micro reactor companies, they seem to be producing just investor presentations. And BWXT Technologies has decades of actually making these things. And there could be a nice little bump in backlog, in demand, which has interestingly led to a backlog increase of 119% year over year last quarter to $7.4 billion. The nuclear energy renaissance is really helping them. Their commercial revenue is growing 100%. Consolidated revenue growth is up 29% or growing at 29%. They've grown revenue at 6% annually since 2013. 13% operating margin has come down a lot. I actually wrote, I wonder why that is. I looked into that after and I forgot to write it down, that they believe that they're starting up a lot of new contracts now. And once you start up these contracts, the margins are low at the start. But then when you have the maintenance revenues, the service revenues that come on top of that, the margins will begin to rise again. It's kind of like investing in the factory and then getting full capacity on top of that. Unfortunately, while this looks like a fantastic business and one I could have bought at under 20 times earnings, I think in 2022, if we're looking at the chart there, it now trades at close to 50 times earnings. It's a real shame. This would have been a nice monopoly asset to own, but I feel like if even being the most generous, we are at fair value right now, if not overvalued.
I wonder if they're benefiting from the energy needs from data centers.
It's possible. I guess I didn't look fully through their annual report and conference call. I believe that could be the case, but what they do have is, again, the contracts with the U.S. Navy, researching the ability to use microreactors for the Army. So essentially having like a storage container, like a storage container that goes onto a ship, and having a reactor there, it's portable. So then you have stable energy, like off the grid. I don't know exactly the use case that would be. I'm not in the Army. And then the space stuff with Lockheed and DARPA. I didn't see anything for what you're maybe thinking about with data centers, but I could have totally missed that. And you could be totally right, because
What do you think the commercial use cases are?
I don't know. Could be that for sure. I did not look that up in the shallow dive here.
Yeah, 50 times earnings is a bit discouraging, unfortunately, but the triple-digit backlog growth on the commercial side is probably the main reason that it trades at 50 times earnings. Let's hop into my third stock, maybe the most interesting of any of the ones I've talked about. This is Kratos Defense and Security Solutions. It's a $15 billion market cap company, and they're best known for their unmanned drones. So there isn't really a single product or segment that drives the business. Pretty much everything I've talked about today is some sort of conglomerate, and it sounds like maybe these big defense contractors will have like a main product that helps the business kind of launch and grow, and then governments will kind of give them custom projects for other solutions over time, and before you know it, they've got 4 different segments contributing to the top line. But anyways, they've got about $1.3 billion in revenue, so a lot smaller than the other 2 businesses I've looked at so far, and they split that into basically 2 segments. So government solutions and unmanned systems. The government solutions accounts for the bulk of the business, 78% of revenue. And this includes ton of stuff. So microwave electronic products, for my non-technical listeners like myself, think of this as small components like attenuators, switches, frequency converters, and often they are compiling a bunch of these small components into a custom assembly based on specific requirements from whoever that end customer is. Usually it's a department in the government. The second one here is space and satellite communications. So Kratos provides ground infrastructure for, I believe it's ground infrastructure software for space missions. They also sell antennas, which seems like there's so many different subsegments of so many different like micro niche products you don't think about that have $1 billion or $10 billion defense contractors behind them. Then the last one here is training systems. So Kratos uses mixed reality and simulation to train soldiers and air crews in basically immersive environments. So it's some of that AR training that a lot of people have maybe seen. And then unmanned systems accounts for basically a quarter of the business. However, this has grown very quickly. So 16.5% annual revenue growth rate since 2015. And for this segment, I think most people can probably envision it just by the name, but when you watch a modern movie with aerial combat, you're likely seeing something that looks like what Kratos builds. It's these big jet-powered drones used by the military, stealthy, pretty cool looking, honestly.
We don't know exactly what they do. That's probably classified, but yeah, I get what the pictures can illustrate exactly what you'd be seeing. And they fly alongside manned aircraft, right?
I believe so.
Maybe it's a different company. But so, for example, the F-35 would have a fleet of 10 of these, whatever they're called.
Yeah, and some of these are apparently designed to be destroyed. So they're designed to basically go into a certain target or wherever, which I would think it's not great for like you pouring all this money in as a company and then it's blowing up.
They need more. They need more. Hey, we got to
That's got to be a cost.
We got to get more of the inventory. What?
That one's got to be a cost plus model, I assume.
Yeah. Well, they're not owning it. They're selling it to the military.
Yeah, that's
and
a good point.
They need more inventory.
Yeah, maybe that's the pitch right there. But of all the companies on my list, this one probably intrigues me the most. And in my kind of quick research for Kratos, something that stood out is that they apparently are considered unique in the defense industry because they use a lot of internal funding to develop prototypes instead of waiting for government funding. So obviously waiting for government funding is a safer play because you're not really risking any capital. But this allows Kratos to kind of stay ahead of a lot of other defense contractors and will likely continue to enable them to grow faster than the industry. And while a lot of these are not cost plus models. So when you're reinvesting your own internal funding, instead of having a baked in margin of like, your cost plus 7% or whatever, you theoretically have higher margins than other companies in the industry. However, at the moment, they are generating less than 2% operating margins because they're going through a big development cycle. They are estimating that they'll get to 5 to 6% operating margins by 2028. But obviously, when they're using internal funding, production cycles can lead to a lot of lumpiness in profitability. Right now, the EV to EBIT is 600 something. So that's because they're hovering right above profitable. And then I think that's pretty much it. I hesitate when something is not profitable and I don't have necessarily a clear view on the path to profitability. Like, this could be one where they're consistently sacrificing short-term margins because they think there's a project worth investing in and they are accelerating revenue growth. And so far that's helped the stock quite a bit. But I don't know. I probably would end up taking a basket approach. If I'm looking at all the stocks I own today, none of these in particular stood out to me as the obvious one to buy.
If you look at Kratos specifically, as a market cap of $15 billion, revenue is just $1.2 billion, and it's not that great. It seems fairly expensive. But yeah, let's close things out with my last stock. A little bit more of a speculative play here, a fun one to end things for people that like that type of stuff. BlackSky Technologies. They operate a satellite network that is used for intelligence for the militaries. Interestingly, 91% of its backlog is from international contracts. They still haven't even won that many deals with the U.S. military. They're at only $20 million in quarterly revenue, but they have hundreds of millions in backlog. Its next-gen satellite can see images of up to from orbit. I don't know if this is low Earth orbit or higher orbit. Again, not going to be a scientist here, but they could see up to a 35-centimeter resolution. That is from space. It's not that's low if you're taking a photo from 3 feet away, but these are from tens of thousands of feet away. And they use infrared sensors to detect objects through smoke, cloud cover, etc. I would say this sounds highly useful for trying to track stuff for military, terrorism, immigration, drug cartels, etc. The old system, I think, had a much lower resolution, so now you can actually see what you're looking at generally. And I assume that their next generation is going to get better. So this feels like a blue ocean of growth, a nice little tailwind of an industry. You're going to want this type of stuff. If you look at what exactly they actually make money on, they sell, again, the imaging services where it's not real time, but within, I think their quota is 90 minutes. They want to say, all right, we're going to be going over an area. We're going to get an image for you. And if something changes, we're going to send it to the general or whoever is in the decision-making capabilities. All right, something changed here. You can make a decision. And they also sell their software that can help with monitoring and kind of sifting through all the images out there. Quote, BlackSky Spectra software uses AI to automatically scan incoming images. It counts ships in a harbor, tracks aircraft on a runway, or flags anonymous activity like a convoy of trucks moving toward a border, and sends a tip to the user instantly. They've had 39% revenue growth since 2020. They're a broken SPAC. They're unprofitable, but they trade at just, quote unquote, just 14 times gross profit. This feels like, even though it was obviously much cheaper, well, I guess I haven't mentioned that, it was much cheaper in 2023, 2024. Feels like a fine, high risk, high reward company if you're confident in them to take a flyer on. Nice little David Gardner type bet here.
This sounds like one that you would pass on and would 3x.
Go 3x. Well, yeah, it's interesting, but again, investors should remember highly unprofitable. Somewhat of a premium valuation and very tiny company in the grand scheme of things here. So it's unclear whether a competitor could step in and win kind of a giant contract from the U.S. government because, again, 91% of the backlog is from international contracts. They've failed so far, at least from the cursory look at things, to win contracts from the U.S. government. All right. Closing question, or go ahead, Ryan.
I love the way all these companies have just super opaque dystopian sounding names. BlackSky Technology,
yeah.
Kratos Security Solutions.
Yeah, exactly. BlackSky Technologies. Yeah, that is. Yeah, some of the stuff will make you think about that CIA and NSA budget, privacy, all that good stuff. But that's a different conversation from whether these are investable companies. I think the concluding question here, and maybe talking about we are interested in defense stocks. One takeaway I would have is that looking at a lot of these companies, they're up a ton in the last year. So are they attractive right now? Maybe, maybe not. But maybe, Ryan, we can go through and rank them from interest, general interest versus not interested. Yeah, I can go first. The two that interest me the most today would be CACI and Leidos because of the valuation and I think general tailwind for the industry. If we look at stocks, I think the businesses I like, versus that are just overvalued. I feel like BWXT and Kratos are both highly interesting, but just traded just too high of a price for my blood. And then Black Sky is obviously very speculative. And then the more traditional ones, L3 Harris and RTX, I'm just generally not interested in those because I feel like they're almost bond-like instruments. I don't know. It doesn't.
Yeah.
It's just not that exciting to me. What about you?
No, I would probably rank them all similar. None of these really individually stood out to me other than maybe Leidos. Like you said, RTX, very bond-like. Same with L3 Harris. You're going to get low single-digit revenue growth most likely, unless I would imagine annualized over multiple decades, you're going to get low single-digit revenue growth. Plus, maybe, not even a lot of margin improvement because of the structure of a lot of their revenue. So maybe you'll get some dividends along the way, but at the moment, that sort of capital returns approach seems to be under pressure politically. So
yeah, but that part is, I guess, a different story. We'll see.
I am interested in the sector because of almost purely because of everything going on geopolitically. None of these companies would if I didn't think that. Now, honestly, if it weren't for Trump's tweet last week, I wouldn't be interested in any of these. But a $500 billion budget proposal increase is massive. I mean, it really is massive. And you could get just the overall basket, the ETF, whatever, the 7 of these up 30% this year.
Yeah.
But difficulty is a lot of this was baked in 6 months ago.
It's been a nice little tailwind in 2023, 2024, 2025 from post-Ukraine war. A lot of these stocks have kind of been pricing in that something like this was going to happen. I think for me, Leidos is one I want to research first, just given, again, I'd like to look at this business further and see why it's trading at kind of maybe a potentially undervalued price versus what I see as a nice little tailwind for the business. But yeah, besides that, I'm with you. It's not that sexy of an industry. It's really durable, in the grand scheme of things, durable cash flow, but not something that's going to be hyper growth outside of maybe this 2027 one-time bump, I would think. At least I would hope, if you kind of get what I'm implying.
For thematic investments, I would like to find ones where it's like this industry 2 years ago, where you're getting you can get some industry-wide tailwinds plus multiple re-ratings across the board. So maybe there's been some depressed valuations, people think lowly of the industry, and there can be room for not only actual accelerations fundamentally at these businesses, but also investors changing their mind about the industry.
Yep. Okay. I think that's a great way to close things out. Let's hit the disclosure and get out of here. Let us know you can comment on any of these. I believe you can comment on both Spotify and YouTube. You can send us an email, DM us on Twitter, DM us on Substack, what have you. Let us know if you like these type of episodes. If you don't, as well, we only want to do episodes people want to listen to, and give us any other secular themes you would like us to study. But yeah, let's hit the disclosure and get out of here. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again. And we'll see you next time.